friends. Welcome back to the Skinny on Wall Street with us, the Wall Street Skinny. I'm Kristen.
I'm Jen.
And okay, wow, we are back in another just freaking insane week. And I'm not just talking about the season finale of The White Lotus. But so here's what we want to do today. There's so much turmoil. And obviously, we had an episode last week, Tariffs 101, right? How do they work? How was this tariff policy implemented? And then some of our feelings about it. Well, obviously, the saga continues. And so not only have there been massive moves in the equity markets, as we have seen, massive volatility, there also have been just really bizarre things happening in the bond market. And I want to actually put this out there because Jen is an interest rate expert. Like, she literally worked at Morgan Stanley, Lehman, Barclays for almost a decade, literally as an interest rate specialist. So like, there's basically nobody I could think of better than Jen to explain this.
Most people are better, but you are so kind.
But you also explain it well. So I'm really excited that you can help break down like why this was such a fucking big deal that we had these moves in the bond market. Because I mean, again, it's like equity markets go up, equity markets go down. They can be quite volatile. I mean, look, we also, when Trump announced his 90-day pause, there was the largest recovery since, what was it? Like the third largest recovery ever? Like the
yeah,
S&P
I mean, it might have
10%.
been one of the biggest intraday moves of all time.
Yeah. So that was insane. Obviously, things have come back down now because people are like, oh shit, we still have 100 and it wasn't even actually, initially they announced it was like 125% tariff on China. It's actually higher than that. So we still have 47% or something tariff on China. We have 10% tariffs across most other countries. We have the 25% on Canada and Mexico. So it's not like we're back to now a zero tariff policy at the moment. So I think that that was starting to like seep in to people. But what we want to talk about is, again, why what's going on in the bond market is such a BFD. Like, why was that such a big deal? And why, by the way, was that the reason that many people speculated was why Trump decided to put a 90-day pause on those tariffs. So we're going to go through and explain what's been going on in the bond market. Jen's going to also talk a little bit about Treasury auctions and all that, which, like, it's funny. I have said this to her before. There is nothing like a crisis to make you really care about stuff that you otherwise would not give an absolute crap about.
We were joking that like if I ever did just like a want to understand how Treasury auctions work, like we'd probably get one listen on that episode. Yeah. But it's like, what happens when Treasury auctions fall apart and all of a sudden global policy hangs in the balance? Like maybe a couple people might care.
Yeah. But then we also are going to talk about how it's impacting other markets. So we, again, obviously have been talking a lot about public equities, but also like what's happening in the private equity space. And so many of our listeners are interested in either working in private equity, breaking into private equity, currently working private equity. So we're going to tie that in a little bit at the end. So with that, Jen, I'm going to kick it on over to you to go through what the hell has been going on.
Yeah, where to begin? So everyone, I think, is kind of up to speed that we are recording this on Friday, April 11th. Just over a week ago, Trump announced these quote unquote reciprocal tariffs on 60 odd of our global trading partners. That's excluding trading partners against whom he had already announced tariffs the prior month. So we entered into the opening shots across the bow for this kind of global trade war. What happened? Equities freaked out, they collapsed. And we started hearing all of these theories circulating about what is Trump's ultimate goal, right? Some, like Elon, argued that the real goal should be kind of a net zero tariff world with our allies, isolating our foes, isolating China, isolating bad actors in the system, et cetera, that should be the ultimate goal. We had some conspiracy theorists arguing that no, Trump is trying to break the US economy in order to force the Fed to lower rates in order to refinance US debt at lower rates. We can address that here in a moment. Ultimately, I think many people don't quite know what Trump's ultimate aim is with these tariffs. They may be some kind of reckoning with kind of the past 50 years of trade liberalization policies. And as Niall Ferguson put it on the Free Press, right, effectively some kind of reparations for the transitioning of jobs away from the manufacturing sector, away from the industrial sector, and kind of an entire segment of the American population and economy over the past 50 years of technology advances, basically trying to even the score for that. And we can discuss whether or not that theory makes any sense either. By the way, I'm not a historian. I'm not an economist. We also recently listened to Douglas Murray on Joe Rogan's podcast yesterday. And I want to be very clear. I'm not just asking questions or anything like that. I'm literally just trying to explain from an interest rates perspective what's happening and why this is also concerning.
And I want to actually just add the commentary with the Douglas Murray, Joe Rogan exchange was basically, Jen sent me this episode, was like, I have never heard someone talk to Joe Rogan like this before, because
I've only listened to 3 Joe Rogan episodes or something like that. I haven't listened to very many.
But he was basically taking him to task for platforming people who are out there saying that like Churchill was the real villain of World War II, or like Hitler wasn't really anti-Semitic, like all these things, platforming people who like really should not have I think a voice to tons of people. People can have a voice and people can say whatever the hell they want. But again, to like give a microphone to someone who is really spreading horrible things. And then also you open the door when you say asking questions, it's like that becomes code for like, I can say whatever I want that can be wildly damaging, but I'm just asking questions. So
I'm just throwing this conspiracy theory out there without the broader context, right? Without first listing the 12,000 things that Winston Churchill did to literally save the world from oblivion. I'm going to list this one thing he didn't do that I find fault with, or whatever.
Well, and the other problem, and I've heard other people say this too, is like when it comes to some of these conspiracy theories, it's very easy to quote unquote ask a question. It's really hard to like prove that like those things are not true. And you need to have so much data to then back up the just asking questions crowd that it becomes, again, almost like asymmetrical fight if you even have a debate when someone is just asking questions, because then it assumes that the other person now has to like do all this factual research to then refute whatever that question is. So anyway, we were not trying to be conspiracy theorists in this. This is what we're trying to get at.
But this is the opposite. Actually, our deep desire here is for our conversation about these policies and how they impact the markets to be as apolitical as possible. That's one of the things we really pride ourselves on. So obviously no one is wholly unbiased, but again, we're just trying to explain the mechanics of how the markets work, what's happening, why we think they might be happening. And we are not even qualified to give investment advice, anything like that. We are just trying to explain the mechanics so you can go feel smarter when you read headlines like gold is soaring, dollar collapsing, bond auctions in peril. Like, okay, if that's not something if you're not used to thinking in those frameworks and in the mechanics of how those different asset classes operate and what it all means, then that can be very intimidating and it feels very scary. It feels very scary right now to someone who has some understanding of how these asset classes work. And so I want to explain why. So basically, to give you a sense of the overall debt picture of the United States, I think that's a good way to start, right? When you hear about, oh my God, the deficit, first of all, there's 2 different deficits that we're talking about these days. We've got the budget deficit, right? Which is how much more America spends at a federal level than we take in terms of income and tax receipts, just like the budget you have for your family. Does the amount of your mortgage and your car loans and your credit card debt well exceed the income that you're taking in for your job? If that were the case, right, it would be really hard for you to go out and open a new credit card or buy another house. Think about it that way, your creditworthiness as a borrower. Well, the US as a borrower has very, very, very high debt levels. Yet we are considered to be a borrower that is free of default risk, meaning that we are 100% guaranteed to pay back our debts, because at the end of the day, we issue our debt in our own currency. So if you issue your debt in your own currency, which you control and print, right, you can make more dollar bills if you need to pay off your debts. Therefore, you can't actually default. But things can still go very wrong for you, right? We have basic supply-demand dynamics 101. If there is excess supply of something, its value tends to decrease. And so if we are constantly printing more dollar bills to pay off our debts, if that's the only way out of defaulting on our debts, we are going to devalue the value of each incremental dollar bill that is paid out. That's not a good thing either. So just because we're free of default risk doesn't mean that we're free and clear.
Well, it's like back to the whole inflation thing, which we just got out of a whole inflationary environment over the last 5 years since COVID. By the way, fun fact, it's my daughter's birthday today. She was literally born as I like had to flee New York City because I didn't want to give birth in New York. For like, how wild is that? That it's literally like 5-year anniversary since like the COVID insanity. So anyway, so I just wanted to make that point that like we had massive amounts.
We were overdue.
We had massive amounts of inflation because of both what Trump and then Biden did from a just like stimulus side of things, pumping massive amounts of money into the Oh, yeah.
But even before then, right? So
True.
so
Yeah,
going
yeah,
back, so again, we've got two deficits. So we've got this budget deficit. Now, this budget deficit has been a result of spending that has been ramped up ever since we had a balanced budget for 5 minutes.
Sorry, I was just talking about the
ago.
inflation side of things.
Well,
That's
what
why
I want to
the inflation
explain.
was,
So it wasn't COVID that just started those policies. This indebtedness and this massive amount of borrowing started because of quantitative easing that happened to get us out of the global financial crisis.
So that was 2008.
So this is really a path that we've been on for much longer. And when the Federal Reserve, who was chaired by Ben Bernanke at the time, decided that we needed helicopter Ben. There was what Kristen's referring to is, I believe there was a cartoon at one point based off of a speech that Ben Bernanke gave even before he held the office, like a lecture at a college, where he said something glibly about tossing money out of helicopters. And so ultimately, when the Federal Reserve decided to enact this massively stimulative policy of lowering interest rates, but also expanding its balance sheet, meaning buying US Treasuries, ultimately buying mortgage, and then in later rounds of quantitative easing, buying corporate debt, like all of a sudden, we had effectively a Fed that is increasing the money supply or throwing money out of helicopters, if you will. So that's why he got called Helicopter Ben. So we've been increasing the monetary supply through these policies of quantitative easing that started in 08, 09, and then carried through in fits and starts, right? Because there was a tapering, like the great taper tantrum that impacted the markets. We then had to do multiple rounds of quantitative easing to get us out of COVID, right? So that was what Kristen was just referring to. So we had been on this massive stimulative monetary policy train that was basically going in one direction for a very long time. Then we reversed course in 2022. So when we reversed course in 2022, we started a policy of quantitative tightening, where it's not like the Fed was going out and selling assets off its balance sheet. It was simply allowing them to mature. And by doing so, reducing the size of its balance sheet and contracting the money supply, right?
And by the way, when we say just like, they're expanding their balance sheet, they're contracting their balance sheet, and correct me
if I'm wrong. Your eyes glaze over?
No, I'm just trying to make it like put it into how I learn stuff. So one of the things that you taught me, well, actually, no, I knew this, but like it didn't really click until I think we've been talking about this, is that if you think about, right, how the Fed controls interest rates, they set the overnight rate, the Fed funds rate. And then the long end of the curve is basically at the whims of the market, right? Like the long end of the curve, it depends on buyers and sellers, people who want US Treasuries, people who don't want US Treasuries. They're buying, they're selling, whatever. However, on top of that, the Fed can control it a little bit because they can buy those longer dated bonds.
Yes.
And so my understanding is like when we say the quantitative easing, part of it is like they're going out in the market and they're buying out those longer dated bonds. And so that is then expanding the size of their balance sheet with the effect of lowering the longer term rates, or in what's happening now with, again, us trying to tighten, we're not actually going out and buying those bonds, which means that, again, we have a lot less control over what's happening to the long end of the curve.
That's exactly right. Absolutely.
Oh,
and the mechanism of and again, when we talk about money supply, right? Like the actual mechanism of how this happens is you have a bunch of bonds. Let's say you're a hedge fund or a money manager or whatever, right? And you say, okay, cool. I want to give these bonds to the Fed, right? Like you literally offer them up in an open market operation through a primary dealer like a bank, where the bank has these bonds sitting around on their balance sheet, and you sell these bonds to the Fed and they pay you with dollars that did not exist before.
Mm-hmm. Yep.
So that's what quantitative easing is, and that's how it impacts the monetary supply.
Got it.
So as they no longer hold these instruments on their balance sheet, as they roll them off, we're not putting any new dollar bills in the system, right? Mm-hmm. And because we're shrinking the size of the Fed's balance sheet, ultimately we're tightening that money supply.
Okay,
so
totally makes sense.
The fear of all this was we were going to have to pay the piper at some point, because you are issuing all these new dollar bills for quantitative easing, you're borrowing all this debt and then selling it back to the Fed effectively. So when is this all going to come home to roost? There were always these fears starting in 2008 and onwards that this was going to lead to some massive debt trap and inflationary spiral for the US government. It hasn't happened yet. And a debt trap is where you need to borrow new money just to pay the interest on your existing debt, not to fund any new operations, not to just stay afloat, right? It becomes this vicious cycle. And countries that have fallen into debt traps before it's not pretty.
Doesn't
You
end
don't
well.
want to fall into a debt trap. But that was always the fear, that we were going to lead to this inflationary debt trap spiral. That is the big deficit, capital D, right? That is distinct from our trade deficit. The US has a trade deficit that is pretty much the result of a century's worth of international policy and trade policy that has gone on ever since the Great Depression, effectively. And we talked about this on the last podcast, so we don't need to rehash all of that. But basically, every administration in the US for the better part of a century has been of the view that actually running trade deficits and being in a place of trade liberalization is great from a country standpoint, that this is a good thing, that being part of this big global trading system and being the consumer at the end of it all, that's where we want to be. That has led to kind of this US exceptionalism. Oh, sorry, go ahead.
And not just the consumer, basically, and having our currency be the currency that everyone like basically has to transact in. Like having the dollar be the US reserve currency and like we
the
hold
global
all this
reserve
power.
currency. Yeah.
Sorry, the global reserve currency and holding all this power on top of that.
Yeah. And so what does it mean to be a global reserve currency? It just means that if people have extra money lying around, it's denominated in US dollars. So we pay them for goods, right? They don't go and spend all that money necessarily. They've got it lying around. It's denominated in US dollars. They're not converting it back into their native currency. And so what has happened with all those US dollars that have been flooded into the system because they're, oh my gosh, US dollars, these are great. What a strong and powerful country that can pay off all its debts and is earning all this income and blah, 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 blah. We're going to go buy US dollar denominated assets like US treasuries. So foreign investors in US treasuries make up some quarter or 30% of the holdings of US debt. That's not an insignificant amount. All of the US's debt is not, now the Federal Reserve does still hold a lot of it, and US citizens hold a lot of it. There's, investment banks, there's all these different holders of US treasuries. But foreign holders of US treasuries are nothing to sneeze at. They are a huge component of this market.
And by the way, we like that because we have a huge deficit, and having all those extra buyers means that the rates that we're paying on that debt are therefore lower. So it benefits us from that perspective as well.
If everyone wants to buy your bonds, then they are willing to accept a lower interest rate as the return on that investment. And so it's not the Federal Reserve alone who is dictating those yields on longer dated securities, to your point, Kristen, since they are actually in a policy of quantitative tightening right now.
Right.
They are fine with those longer interest rates rising. But as long as there's significant demand for those US treasuries, then that's going to keep rates artificially low. And again, for all of you belly aching about how high rates are, they're not, okay? We don't need to get into it again. We've talked about that ad nauseum. So here's where we are now. Having entered into the opening moments of potentially a global trade war, when equities started becoming volatile, that's one thing. To your point, Kristen, equity markets go up, equity markets go down. I think we could make a very strong argument that the exuberance that we had seen in 2023, 2024, where all you had to do was whisper the word AI and everything went up another 5%, may have been a little bit of reckless abandon. So it's quite possible that the equity markets were due for a natural correction anyway. That's not my wheelhouse, but I can tell you this, coming into this year when we had the unbelievable opportunity to go to Global Alts at Miami, the optimism in the air was palpable. It was, this is a pro-business administration. M&A deals are going to be on fire. There's going to be IPOs like crazy. This is going to be amazing for business, right? Now, with these tariffs, the general thinking of the market is that any potential increased costs in those tariffs are going to get passed along to US companies and ultimately passed along to the US consumer, which means lower profits for US companies and higher inflation for the US consumer. Both bad. Everything's more expensive and everyone's making less money. Very, very bad. Okay. So that explains why the equity markets have gone down. When you see risk assets fall apart, like equities, what you would expect, all else being equal, is people saying, you know what, I'm really nervous about how much money all these companies are going to make. I want to go buy something really safe, like a US Treasury. Because again, right, US Treasury bonds, default risk-free, yay, okay. So that would be what we call a flight to quality trade. And that's typically what you see when things start to go really, really wrong, is that as equities sell off, as their prices go down, interest rates rally. They go down because more investors are flooding into safer assets, higher quality assets, and they are willing to accept a lower yield on their investment because they just want it to be safe. Okay. That's not what we saw. Instead,
we did initially. We did in the very, very
we saw
beginning.
like 5 basis points. Yeah.
No. Well, no, because remember, I think that like in the first couple of days, that was the whole theory. That's what sparked this idea that like Trump.
But it never materialized in any big way. I think the biggest interest rate rally that we have is like 10 basis points, like intraday. Yeah,
and
no,
so
it was not a big move.
Okay. And so just to like double click on that really quickly, if like you didn't listen to the last episode, because Jen has a really wonderful video that explains all this. But part of the thing is that like Econ 101 and just like a basic understanding of what this type of trade policy will do to the US is it's nothing good. And so everyone has been like trying to understand like what is the 40 chess move, because none of it makes any sense. Like there's very few people who have an understanding of like, again, how the whole economy and economics and all that shit work. Like again, Peter Navarro, you have like one guy who's I guess pro it, but like, and Howard Lutnick, but for the most part, everyone's like, what is the master plan? And people thought that that Trump was maybe trying to throw us into a recession. So that
a small segment, again, we talk about fringe theories. This is a small segment of the population.
Your father, very true. Jen's dad is like he watches CNBC all the time. He's a former like finance guy, and Jen was explaining this to him, and he's like, nobody's saying that, Jen. And
he's
Jen
like, nobody thinks this.
People are.
He's like, why are you spreading this rumor? I'm like, I'm not spreading the rumor. I'm reacting to this rumor that people think
this
that. So there was this theory that Trump was deliberately tanking the economy to force the Fed to cut interest rates, to therefore be able to. So coming back to our budget deficit, we've got $36.2 trillion worth of US federal debt outstanding. Now, that debt is not all issued in one maturity, so that you have this massive concentration risk where every year we suddenly need to refinance $36.2 trillion worth of debt. That debt rolls off in staggered buckets of maturity. So when the US does auctions, and we'll talk about auctions here in a second, they issue anything from like 4-week bills to, 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, 20 year, and 30 year treasuries all across the yield curve. So we constantly have debt that's rolling off that needs to be reissued. And this happens every single month that there are these auctions, and we'll talk about them. But just to give you a sense of the order of magnitude, this particular year, this is not like some massive cliff that like everyone was thinking about. This year, because this is the order of magnitude of debt that we have. We have $9.1 trillion worth of debt that is going to need to be refinanced in order for us to keep the lights on in the country, basically. Yeah. Well, I will say this, actually. Part of the reason that the order of magnitude of that refinancing is high is that when rates were cut to zero, instead of terming out our debt all the way, saying, you know what, oh my gosh, like rates are zero, let's just go issue a bunch of long bonds so it's tomorrow's problem, right? We did, and we reintroduced the 20-year. There were no 20-year auctions, by the way, when I was working in the seat. Bonds were reintroduced. Long bond auctions were reintroduced literally the first year I started on the desk because they had done away with those. But we have termed out our debt, but we didn't term it out in the global financial crisis. And we didn't term it out. And we didn't term it out enough. We have been issuing a lot. We issued a lot of short-term debt when rates were at zero, rather than reorienting the concentration of our issuance to the long end sufficiently. So we do have a lot of short-dated debt that's rolling off that now we have to refinance. And that is part of why that order of magnitude is what it is. Yeah. Beyond the scope of this podcast as to why we did or didn't do that. But so the theory and the concern is, okay, now we've got, at the bare minimum, $9.1 trillion is worth of debt that we plan to issue this year. By the way, at any point, that funding need might be revised. Like, that's not a fixed number. We might say we need more now. We need to up the size of these auctions. So that could change too. But for now, that's the bare minimum of what we need to issue.
I assume it would possibly depend a little bit on what happens with the tax thing that's going to go into play, or...
Well, that's a great question. So that's beyond the scope of my knowledge in terms of if we ultimately get a tax bill, what does that mean for our issuance needs in whatever it is, 2026? So that's a great question that I do not know the answer to and probably should. But so the big concern that has materialized in the markets over the last week or so is this entire announcement coincided with the regularly scheduled 3-year, 10-year, and 30-year auctions. Now, it's April. So this is how Treasury auctions work. You have quarterly refundings. So that's like the big guns, okay? That's like the big events. So every February, May, August, and November, we get new 10-year notes, new 20-year bonds, and new 30-year bonds. That's a big chunk of supply. We're talking like 45 million 10-year notes, like a huge amount, right? Then at the monthly auctions, every single month, we always get 2s, 3s, 5s, 7s. We also get reopenings of those 10-year and 20-year and 30-year bonds. So we add to the outstanding amount, but it's the same maturity. So if in February, the Treasury issued a new 10-year note that matures February 15th, 2035, in March and in April, we then get 10-year 11-month notes and 10-year 10-month notes, right? You see what I'm saying? So they're the same. It's the same issue. It's just being reopened. So this whole announcement of the tariffs happened last week. And on Tuesday, Wednesday, Thursday this week, we had 3s, 10s bonds. So what the market always does is it knows this supply is coming, right? If you know that there's going to be a great amount of supply of whatever it is, right? Increased supply, all else being equal, equals lower prices. So we do tend to see some kind of concession built into those parts of the yield curve as the auction approaches. That's a very normal thing to happen now. If there's other market dynamics happening, right? If there's a big flight to quality trade and everyone wants these bonds, like you're not going to get a concession. You're going to pay through the nose for those things.
Right.
But all else being equal, you should see a little bit of a concession. So like you have that seasonal market dynamic that like maybe people weren't thinking about. But again, all else being equal, if equities are going to sell off 5 or 7%, and you just have a risk off trade, shouldn't there be massive demand for these auctions? The real concern was, well, now if we have a total reconfiguration of the US's relationship with the world and our trade partners who are used to taking their dollars and using them to invest in US dollar denominated assets, and they are all of a sudden getting screwed and they're very unhappy with this trading arrangement. And they say, you know what? I'm not going to be getting any more of these US dollars because we're not going to be trading. We're not going to do business with you. We don't want any more of this. Or we want to show you just how unhappy we are with this policy.
Oh, and we can inflict pain as well. Like you think
and how miserable we can make your life potentially. Yeah. What better way to send a message than through these bond auctions? I'm just asking questions. So what ended up happening is despite a little bit of an initial flight to quality trade, what we saw was basically long end rates, so 10s and bonds, going from pretty much unchanged to selling off and selling off more and selling off more.
And by the way, just to give you like a sense of the magnitude, you had messaged me this because, again, my husband and I, of course, are the morons who had to buy a house in like 2023 and therefore like didn't get a low interest rate. And you had messaged me the day after April 2nd, April 3rd or something. And rates had come down enough that you were like, I'm going to reach out to some of my old clients and tell them they should maybe look into remortgaging their house because, you know, potentially this means rates are coming down. You know, that
was clients who had locked their rate earlier that month.
Oh, okay.
Yeah.
You know, yeah. So the point, though, is that interest rates, I don't know where the 10-year was before.
We were hovering in like the 4 1/8 to 4 1/4 range in and around the time of March.
Okay. So it dropped to 3.9%, which is huge. Like those types of drops are significant. And then over the next couple of days, it was up, and it got up to, I think, what was it like for the 10-year, which is like the most, that's kind of like the benchmark that people tend to focus on the most because it's like the most liquid. That got up. And by the way, it's also the benchmark off of which people tend to think about mortgages being priced and corporate debt being priced, all that kind of fun stuff. But I think, Jen, when you shared a screenshot, it got up to like what, 4.4%?
450. Yeah,
4.
I mean, I think maybe the local high, and we're there now, by the way.
Which is huge. Like the magnitude of those. I remember you had done an Instagram reel, not in the last week. This was like, I don't know, 6 months ago. You're like, oh my God, the 10-year moved 10 basis points. And actually it was about that big trade. And people were like, that's like 10 basis points. 1 basis point is 1/100th of a percent. And people were like, that's tiny. Nobody cares. You were like, no, that's so big. So the fact that this was like 60 basis points, like 60, that's over 0.5%. That is huge. So as a non-bond person, I get to kind of like watch Jen's reactions to things because she gets very excited, but also see, oh my God, this is a big deal. But these are not insignificant moves. These are like massive. So just wanted to make that clear.
No, absolutely. And again, just think about the order of magnitude. Just rough math here. If we were to talk about doing 25 billion worth of 10-year notes at an auction, let's just say for nice round numbers, each basis point that the interest rate moves on that total auction size is worth right now today $18.75 million.
Wow.
Give or take. So that's
1 basis point.
0.01%.
Yeah.
So if you get a 50 basis point back up in rates,
60, because I guess, yeah, I think it was 60.
That's $1 billion right there.
Yeah.
So the order of magnitude of these interest rates moving and the impact of that over the life of these bonds discounted back to today and present value, right? If you get a 50 basis point back up in just 25 billion tens, that's not all the 10-year notes outstanding. That's just potentially the size of the auction, right? That could be worth $1 billion in increased interest costs discounted back over the life of those 10-year bonds to the Treasury today. So that's a really meaningful amount.
Yeah.
And so we had this big backup in rates, and then we had these 3 auctions. And so the 3-year auction, again, shorter duration, everyone doesn't care as much. That took place on Tuesday. And when an auction happens, the bonds are trading at a yield going into the auction. The bonds that are going to be issued are called the when issued or WI bonds. So they have a WI yield, and they trade as a yield spread relative to the current 3-year note that's rolling off. I've explained this before, I think in our Instagram stories, but think of it, although no one's going to
I think we did a silly video soon, too, where we it was with the girls. Yeah.
Yeah. But think of it as every new auction is like a new model of the iPhone, right? Mm-hmm. You want the latest version of the iPhone, and that's the on the run 3-year note. But the second they announce that there's a new iPhone coming, you're like, oh, well, how much more am I going to pay for that new iPhone relative to what I paid for this one, right? And all else being equal, it should be more expensive. So generally speaking, there is a positive yield spread because investors are going to, demand more term premium to extend further out the curve by just that 1 month. That's worth something, right?
Oh, and it's just for that 1 month.
It's worth anything for, a day, right? Yeah, the yield curve is that incremental. So if you extend maturity by just a day or by a week or by a month or by a year.
I never even thought of that. Yeah. Mm-hmm. Oh, that's so interesting.
That is increasing your term premium as you go locking in
a rate for a longer period of time.
For a longer time, right?
Yeah.
The current on the run 3-year note, by the time you issue the new 3-year note, is a 2-year, 11-month note. That's a totally different part of the yield curve.
It's like I get to learn stuff in real time. Yeah, this is okay. Makes sense.
So you A, have additional term premium, and then B, you have so much supply. So you should demand some kind of concession in price to take that down. So that's where the little iPhone analogy breaks down, right? But anyways, so it'll typically trade at a positive yield spread unless we have an inverted yield curve and all that fun stuff. But anyways, going into the auction, rates started to sell off a little bit. And then the auction comes at 1 p.m. So we see where 3-year notes are trading at 1 p.m. going into the auction, where that WI is trading. And let me go back a step. So Treasury auctions are Dutch auctions. It's not like Christie's and Sotheby's where the highest bidder gets the whole thing. It's what is the actual yield that the total number of bonds can be sold with no remainder. So if I'm really desperate for these bonds, I might be willing to pay, again, let's use some nice round numbers. Let's say 3-year notes are at 5%, right? If I'm really desperate for these bonds, I'll say, give it to me at 4. I'll take them at 4, right? I don't care. Just give me all I have. I'm just willing to take whatever I can. If you're kind of well, I want them, but I don't want to pay too much for them, you might just bid 5%. Right? And say, you know what, that's where they're trading. That's where I'm willing to take them. I'm not going to pay more, but I want them. Okay. Mm-hmm. And if you're like, I don't really want these things, but I'll take them for a great deal, you might bid, again, for purposes of exaggeration, 6%. You'll say, hey, if I can get them 100 basis points higher in yield than they're currently trading, I'll take that all day, every day, but I'm not willing to pay up for them here. So if it comes right where it's trading at 1 p.m., that's called being on the screws. If it comes rich to at a lower yield to where it was trading at 1 p.m., then that's called stopping through. And if the auction comes at a higher yield to where it was trading at 1 p.m., that's called stopping short or a tail. And so if the auction stops short or tails, that means that there was less demand. There wasn't enough of a concession going into the auction.
And so in your example, if it was previously trading at 5%, you had those 3 bidders, 4, 5, 6, it would go at 6 because that's what they would have had to.
6 is a tail. Exactly.
And in that case, it would tail.
Yes, that we would call that a tail. That would be such an unimaginable magnitude of tail. So let's talk about it.
Yeah. You're like, so it's usually like 3 basis points.
Yeah, we had like a 2.5 or 3 basis point tail in the 3-year auction, which whatever. That's a good sized tail. So that's a little concerning. But what was much more concerning was the actual breakdown of bidders in the auctions. So there's 3 types of bidders in Treasury auctions. There's direct bidders, indirect bidders, and dealers. So a direct bidder is someone who actually has an account set up with the Treasury. Now that could be anyone, right? Like you could be a pension fund, you could be an insurance company, you could be a hedge fund, and you could have an account set up with the Treasury. And that's because you're doing so much business with the US government that like you need an account set up, and like they have all your numbers for the wires and like managing all the cash flow back and forth, right? A lot of people are like, I don't want to bother with that. That seems like a big hassle. So they may not have those accounts set up, or they don't feel like going in and inputting all the things themselves, right? So a lot of people may choose to be indirect bidders. And so they would say, hey, listen, instead of going and setting up an account with the Treasury, I'm going to call up an investment bank. I'm going to call up my Jen, interest rate salesperson. I'm going to say, hey, I want to bid in the Treasury auction. Here's what I'm willing to offer, like blah, 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 blah. Cool. Then there's dealers, pretty self-explanatory, banks who are buying for their own portfolios. So we have those 3 types of bidders. Foreign governments can either be direct bidders or indirect bidders. So this is one of those tricky things. Because direct bidders can represent so many different types of parties, and we don't get the breakdown within direct bidders, like there's some privacy with this. Yeah. So we don't get the breakdown within the direct bidders of who was actually participating in what order of magnitude. But each maturity of auction has kind of a typical percentage of direct bidders. And just going back to the math that we established early in this episode of the fact that foreign investors hold something like 30% of US government debt, if you see direct bidder participation in an auction somewhere between, call it 15 and 30%, that's pretty good direct bidder participation. And again, participation is calculated based on the winning bids, not the total bids, right?
Oh, interesting.
So think about it this way. It kind of only matters what the winning bid was, because if direct bidder participation, if a huge number of, say, foreign governments said, oh, we'll play in this auction, but we're only going to play if, in our example, it's being auctioned at 5%, we'll only play at 6%. They're not getting any bonds if that thing stops at 5.03, right?
Got it.
They're bidding way too low in terms of price.
Because not everyone necessarily is going to get those bonds.
Right, exactly. These auctions typically have orders of magnitude more orders placed in them than who actually gets filled, right?
Got it.
Think about, in corporate finance terms, either an IPO or a debt issuance. Yeah. Those books are typically multiple times oversubscribed.
Yeah.
Treasury auctions are typically multiple times oversubscribed. Okay, but the composition of that oversubscription is very important. And who ultimately gets filled is what matters truly at the end of the day, because that tells you how willingly direct bidders, like foreign governments, like pension funds, insurance companies, et cetera, but we're kind of focused on the foreign government piece right now because they can be a big portion of that direct bidder. How many of them showed up and bid for bonds at kind of the market rate really matters. So when that 3-year auction happened on Tuesday, we had the lowest direct bidder participation since COVID. So that is a really, really scary metric because, okay, just going back to COVID, who probably wasn't participating in our Treasury auctions?
Probably
during
China.
The very first months of China.
Now
I'm just going to say this all the time. I'm just going to say just asking questions, like just to troll myself. Then we had the 10-year auction.
They were dealing with this little thing called COVID, which was had originated in Wuhan, and there was a whole. Yeah.
So then on Wednesday, we had the 10-year note auction. We sold off 18 basis points into the 10-year note auction. So that's a big concession priced in, building in a big concession for all that supply because people don't feel really great about buying these bonds right now. Then we stopped through, but direct bidder participation was 1.4%, if I remember correctly. And the average for 10-year auctions lately has been 17.5%. So less than 10% of the average direct bidders showed up. So we had 2 very concerning auctions. Again, 3s, okay, concerning, but like, nah. 10s, big deal. Then we have long bonds the next day, right? What happened 10 minutes after that 10-year auction?
Trump announced that there was a pause.
Trump announces a 90-day pause on tariffs.
Well,
all of a
and
sudden,
to be fair, on some tariffs, like
on the reciprocal tariffs on everyone except for China, basically.
Yeah. But there's still the 10% default, and then there's still this shit going on with our, north and south neighbors. But the market was really happy.
Wrong. So just to harp on this, does that mean that with Canada and Mexico, like no change to their 25% tariffs because they weren't part of that reciprocal tariff?
Yeah.
Well, okay.
And I believe
so we really should be saying, because we keep saying no change to China, but like we should also say no change to Canada and Mexico. I feel like that's an important thing that we're not saying enough.
Yeah, Canada and Mexico. My understanding is that there's still the 10% base on all countries.
For everyone, yeah, because it was just the reciprocal piece. That was like
and then again, because the Mexico and Canada, if you remember, he did announce a pause at one point.
But then we unpaused, I thought, with Mexico and Canada.
Exactly. They've gone into effect.
Oh, yeah.
So that's the whole thing, is that the equity markets, just to kind of like add in what's kind of the color, they massively rallied, right? Because pause on tariffs, yay, like everyone's so happy. What day was that? That was Wednesday, I think. It was Wednesday.
What, when he announced the pause? Yeah, he announced the pause on Wednesday, right after the 10-year auction.
Exactly. And so then on Thursday, as the reality of the fact that like the tariffs aren't entirely gone.
But hang on 1 second, because I just want to explain. Yeah. So on Wednesday, right after the 10-year auction, he announces this 90-day pause.
Yeah.
And so this is why one might theorize, because equity markets had been in free fall, basically. But I would argue that it was the bond market that made Trump come to that decision.
That has been overwhelming.
And so this is all the evidence that we presented as far as the backup in yields and the low direct participation of bidders at our auctions.
Yeah.
If there was someone wanting to send a strong message to President Trump that this policy was a bad direction, those auction stats were the way to do it.
Yeah.
And so what happened, then we get this big equity market recovery, whatever. Now Thursday, we have to take down bonds. So the question is, was the message received, right? Did the bond market take it the way that it was intended? And so, yes, we backed up into the Treasury auction. The Treasury auction stopped through. So true, we had a good concession going in. Twos bonds had steepened considerably. All these fun things that you kind of would expect to see before an auction, especially in shaky times.
Yeah.
But we got close to 30% direct bidder participation in the long bond auction. To me, I interpreted that as the global markets giving Trump the signal that, like, thank you, this is what we wanted. You play nicely with us. We will show up to your auctions.
Yeah.
However, here we are and it's Friday. We've chopped a lot of wood since the bond auction yesterday at 1 p.m. It's 10:13 in the morning now. So what's happened since then? Well, as you said, Kristen, the market has come to grips with the fact that a 90-day pause does not necessarily mean a revising of this policy. It's just kicking the can down the road and hopefully providing enough time for negotiations, while over that time period, the back and forth between the US and China has only increased in its pace and severity. So what I think is so concerning now is, even though we just had a successful bond auction, we are seeing rates continue to sell off. So 10-year rates have sold off, as the time of we're recording this, another 12.5 basis points. So we're back up above 450. Yeah. So that's just intraday today. Overnight, the US dollar got smacked down. Gold is soaring. These are all of the metrics that we were talking about just a week ago here, signaling that very real concern that I still have, which is that the market is starting to consider as a much higher likelihood a world in which the US dollar is no longer the reserve currency of the world.
And I keep saying this, like, my background is more on the corporate financing side. And this is why this is so fun for me, is I get to learn and like stuff that I like knew, but like I didn't really know and like internalize. But I think that one of the things is the connection between, again, like the US dollar and then sort of the treasuries and then the trade aspect. And so I think you did a video on this. You definitely explained it in the newsletter, which was just like, how did those things all tie together in the sense that, because again, we have this huge deficit, all of our trading partners are getting, again, like it's us here in the US paying these companies in US dollars. And a lot of these companies then do not need to like hedge their FX risk. Like that's the whole thing. So it's like you have the deals in the US Treasury. Then there's also that FX component, right? So it's like the dollar yen or like the dollar krona or whatever it is. And the impact of, do people want US dollars? And so that then reflects that exchange ratio. And the fact that the dollar is getting crushed is very, very, very concerning.
Mm-hmm.
And I don't know if there's anything more you want to add. Again, if you want to
I
explain for
think
someone
you
who's like
raised a really good point before we started recording, which is there may be this kind of missing mental step. Actually, there was a great episode of Industry where Harper saves the day. Because she figures out that one of the hedge fund clients of the firm is going to participate in a block trade or in the purchase of a stock because she did an FX trade. So how did she come about that? Well, she goes and she like calls the portfolio manager
who's based in Germany.
Suspects is going to, yes, correct. They are a EU currency denominated hedge fund. They are German based, but they are going to be buying a UK based stock called Fast Aid that Harper is trying to suss out whether or not this hedge fund is going to buy this stock. So even though she doesn't have a line into this portfolio manager, what she sneakily does is found out that that portfolio manager had gone and done an FX trade and she had sold euros to buy sterling. Why? Well, because when you want to go buy an asset denominated in another currency, you first need to raise that currency if you don't already have it lying around in your coffers. If you don't just have a bunch of pounds lying around to pay for things, you need to go get pounds. If you don't have a bunch of US dollars lying around to pay for things, you go and you buy US dollars.
Yeah.
And if you live in a world where people want to buy US dollar denominated assets, they are either not selling the dollars that they get paid in exchange for their goods. They're not selling them and converting them into their existing currency, which when you don't sell something, that props up the other currency, right? They're keeping those US dollars and they are then going and buying whatever it is, US dollar denominated bonds, US equities, et cetera, et cetera. Or if you actively want to buy those assets so much, you might sell out of your native currency and go raise dollars to buy even more of that. Yeah. So there's that FX trade that has to happen for foreign investors. Either it's an implicit trade where you don't sell the dollars that you get, or it's an explicit trade where you actively go and raise dollars by selling your own currency. And so in a world where American assets are viewed as desirable and favorable, the dollar is all else being equal going to be stronger. Things that might hurt that, for example, are easier monetary policy. If we're going to lower interest rates on our bonds and you're getting less of a return for those interest rates, you're not going to be as excited to go buy those bonds. So you're not going to raise as many dollars to go buy those bonds versus higher yielding assets elsewhere. So all else being equal, easier monetary policy points to a lowering of that currency. But also, all else being equal, if you view the US as kind of up on a pedestal as the least risky country to invest in, then if anything, even if you think we're headed towards easier monetary policy because the Fed is its hand is going to be forced, and not only will they have a rate cut, but in fact, an entire reversal of quantitative tightening now going to quantitative easing, which would be an overwhelming policy reversal, then you would think that flight to quality, if you think we're quality, would overwhelm the impact of that monetary policy on the dollar. We are not seeing that. We are seeing a weaker dollar and we are seeing gold go through the roof, which I don't want to own any of these currencies. I think we're going back to the gold standard. We're going to start, trading sheep for things sorry, I don't mean to be glib. Like the gold buyers out there are crushing it. Like, good job.
Yeah. Well, I mean, it's scary because there are downsides to being the reserve currency, to being like the world superpower, all that kind of fun stuff. But we are basically almost like willingly trying to give this crown up. I think having influence over countries and being able to help shape policy internationally and not have China necessarily doing that, or Russia or North Korea. Like, I think that's a good thing. Like, call me crazy. I feel like if so many people just want to have their cake and eat it too. It's like, you can't have both things. And I just feel like people are missing that we have been so privileged, and this is something we really could lose.
Yeah. Nature abhors a vacuum. If you create a vacuum with the suddenness of a policy change like this, you can't control what rushes in to fill that vacuum. And that's what has scared me. And I think after this, we're going to air our episode with Steve Eisman, who, if you guys have seen the movie The Big Short.
Yeah, so we're going to do a separate episode.
But he was of the total opposite view. And, you know, I was sitting there like visibly shaking while we were recording with him. And he was like, everything's going to be fine. It's totally fine. And what I said to him by the end of the conversation was like, you're an equities guy. I'm a bond girl. And I do think there's like a fundamental doom and gloom about bond people that like we always joke about. But I actually think that that's what the market's reacting to now is, again, equities up, equities down. The overall level of the S&P doesn't keep me up at night. What keeps me up at night is the potential for failed U.S. Treasury auctions, for a round of quantitative easing when I don't think that that helps us in any way, shape, or form. And I think runs antithetical to, if we do want smaller government and we do want more controlled spending, quantitative easing is not the way to get it. Expanding the Fed's balance sheet is totally antithetical to those policies. You had said something, Kristen, yesterday about what Niall Ferguson had said on Honestly with Barry Weiss, that this feels like reparations to this entire generation of Americans who lost their job due to kind of just the changing world. And I was like, but it's not reparations. It would be like if you thought
at least with reparations, an American is getting money and is benefiting. You know, it's a direct transfer.
Right. Versus, I was like, this is like if you felt you needed reparations from me, so the government came and took my money and then came over to your house and used it as kindling to burn it down. Both of us lose. And I think, if anything, if it really is supposed to be a redistribution of wealth from the class of Americans who has benefited from the run up in the stock market, who has benefited from all this leverage, if it's supposed to be money out of their pockets and into other people's pockets, I think we're kidding ourselves. I think it's going to be money out of those pockets, but those are deep pockets. Those deep pockets can withstand that hit much better than the class of Americans who lost those jobs and haven't recovered from 50 years of policy.
But one of the things that I just like fundamentally, and maybe there's data to back this up, I fundamentally disagreed with this argument that it's basically us elite who have benefited and not other people. Because again, what happened is there's just been a shift away from the manufacturing jobs to service-based jobs. That includes people who are doing things like, again, being teachers, firefighters, who are nurses. And by the way, we are a net exporter of services into the world economy. And those tariff initial calculations didn't take that into effect. But the other argument that I've heard against some of these trade policies is it also is basically giving a crutch to American manufacturing instead of forcing them to be entrepreneurial and to make it better. And had we put in these policies 50 years ago, like you can't see what would have happened at that point, because I actually think we would just be, again, less entrepreneurial. There would be fewer successful companies, fewer innovators. And so I think that this is why, to me, it's so frustrating seeing how this is all getting put into effect, is because I think it's partly I just fundamentally disagree with like the worldview that I think people are trying to correct for. And I understand that people are going to have different worldviews. But I feel like we are so fortunate here in the US. And I do think, look, there are a lot of people that have been hurt, but I don't see how this helps that. That's what I struggle with so much.
Yeah, no, I mean, I think you made a really great point there and kind of glibly said, this is the big bailout for coal. Like, you know, we had bailouts for banks.
There was literally just, but that was the other thing. There was literally just some executive order for coal, which is now more expensive than much cleaner sources of energy. And by the way, in this whole AI revolution, we need to find more sources of energy and we need to get more efficient there. So like, what are we doing? It's like the opposite. I think it's, again, a nostalgia for this world where you would have this blue collar worker in a hard hat who's like going to work, has a wife at home, who's supporting kids. And that's this old world where, again, those manufacturing jobs were really well paying. Maybe they will be again. I don't see how that happens with automation. I don't see how that happens if we want to continue to be best in class innovators. That's not the world we live in today.
Those jobs and the support for those jobs in an economy that has been trending away from those jobs for decades.
And by the way, this is every country.
I believe in capitalism. And so unless you have government subsidies for those jobs, which again, bigger government with more control over price action is not the free capitalist society that I think we all believe in. That's not what we want to see, right? We want to see free markets and we want to see the best idea win. And I'm very empathetic for people who have lost their jobs. But I also think we need to ask some questions about the kind of education system that we have in this country.
Oh God,
and how we are teaching. Well, that's exactly right. You and I are so fortunate. Think about it this way. I've had like 4 different careers and I'm only 40 years old. But because I was very fortunate and privileged to get a great education, I can go be a jack of all trades, master of none, or pivot from this or pivot from that, right? Because I have education. And if you don't have education, then I completely understand how you would be like, these jobs need to exist to the level of education that I have access to, right? And why are we solving, I think we're solving almost the wrong problem. What if we could, instead of trying to handicap ourselves in this global trade picture in order to, again, drive more jobs that I think we can make a very strong argument for most people not wanting to work in or not being able to work in as robotics increases. A lot of Gen Z doesn't
even want to go into the office 5 days a week.
Oh, correct.
Like,
no one wants to go be an investment banker. Yeah, exactly. But if we could strategically invest in education to get the average American more competitive in the kind of global job market that we exist in now, I think that would be such a better use of our time, energy, and policy if we could. And I don't know the path to that. This is so far, all of this is so above my pay grade. Guys, we're just teachers.
I think so, that you're
if you want to talk about the
right,
mechanics
though.
of bond options, I can do that all day long. For me to speculate about the best way to do this, I'm simply not the right person.
I want to say one more thing, and then I do, because I do want to touch on like some of the private market stuff, but I think it's funny. I'm about to have my 4th child. I so strongly believe in sending them to school. And there's obviously a huge homeschooling movement. And it's funny, at one point, like a light bulb went off that to me, it's so obvious that of course I'm going to send my kid to school and they're going to get the education, because I live in an area with the best public schools basically in the world. And so many people, they send their kids to these schools that are absolute dog shit. They don't learn anything. It's probably there are so many bad schools.
Yep.
And so I understand why, if you were someone who was in that situation, why you would choose to homeschool your kid, because you're like, I can do this so much better than whatever they are doing. But I think the solution is then like, let's actually try to make this.
Let's make better schools.
Make better schools.
Yeah, I mean, and the problem is, right, is like, okay, who's going to invest that time and energy and money?
Right.
Like if you're the parent and you have no options in your community for schools,
and
to
you
be
love
like,
your
well,
kid,
I'm going to force my child to be part of this like thing that I think is actively hurting them.
Yeah.
I can totally understand why you would opt out of that choice. Right?
And again, I would probably make this, if I wasn't privileged the way that I am. And again, I'd be like, I'm homeschooling my kids all day, every day. I'm not sending them to this shitty school that's right here. I can't afford to pay $50,000 a year to send my kid to private school. So yeah. Anyway, I just wanted to add that point that I feel like we're going backwards so much. And again, this is not a political thing. Can we maybe like make a better Department of Education then, and not just like burn it all down? And I just wish there was people who were like, let's try to set policy at the federal level so we can get good teachers. Like we can do something and we can actually like invest in these towns and places that don't have good schools. Like maybe that's what we should be focusing on.
Instead of like, let's like bring a job back. I don't know the mechanism.
The Howard Lutnick, like we're going to have, lots of people screwing in screws in an iPhone. Really? That's what you think? Like, that's actually to me insulting, that like you think that that's what people should aspire to. It's so fucking insulting.
Yeah. No, I think that's a really great point. And
it's as bad as like the argument that math is racist. I'm sorry. Right. Like that in of itself is racist. And what he is saying is in the same way, it's just a slightly different way, that like you need to aspire to screw in screws on an iPhone. Excuse me? Sorry. I'm like getting so mad about this, and I'm going to stop talking before I get myself into trouble.
I totally agree. The ultimate conclusion I always have with this is, if this is all part of some bigger negotiating plan, great. I would love to see that happen. Let's go. And I know it's still so early on, but it's funny. I'm getting text messages right now being like, who's selling bonds? Who's selling treasuries? Who's doing it? Is it happening within the US? And to me, the market is sending a very, very clear message. So the market's not dumb. So if bonds continue to sell off, the message is clear. There is no faith in the path that we are on. So you have to restore faith of the path that we're on. And you can't just do that by saying, be cool.
Don't be a panican.
I'm a panican. Cool. I am the actual leader of the panican party. And I think everything is doom and gloom. And I'm just a little person, right? Like I don't matter in the grand scheme of things. That's totally fine. But you need to restore faith, not in the equity markets, but in the bond markets. That's where it needs to come back. The bond markets do not feel good. And if the bond markets don't feel good, everyone's going to feel bad for a very, very, very long time.
I wonder, a lot of stuff starts to trade like meme stocks. I mean, honestly, like the entire stock market is starting to trade like a meme stock. But I mean, like Newsmax, I think it was a Newsmax that went public and like they've had like a loss and they were trading at some insane valuation. There's a lot of retail buyers. I think there's a lot less people who are like buying in from a meme stock mentality into the bond market.
This is an untradeable market on all fronts right now. I mean, I do not envy. If you are sitting in a macro hedge fund and you haven't gotten a tap on the shoulder, you deserve a medal. Like I don't know how anyone is not blowing through risk limits or how you guys aren't staying up all night. The orders of magnitudes of these moves and the unpredictability of it, like I just don't know how you can, with a clear head, invest and feel comfortable with that decision in pretty much any asset class right now.
Yeah. All right. So really quickly, I did want to touch on just like private equity because that's the whole thing. It's like, it's private, so it's not affected. Well, actually, no. Private equity.
Well, so explain why if it's private, it's not affected.
That's
because I think like getting to that philosophy of volatility laundering is really important.
Yes. Okay. So in general, think about just like yourself. If you own all of your investments, and let's say you are fortunate enough to have bought a house, you buy a house, you live in your house. It's not like the market goes up or down and you're going to sell your house because there's been a bad day in this market. The equity markets or the bond markets, whatever, public markets, you can see second to second what is happening. And you can see, by the way, like you check your 401k, you're like, oh shit, I just lost.
For me, I'm literally, every time you see my eyes go over here, I'm just watching the markets. Like I am watching on my screen right here.
But so this whole idea with volatility laundering is that, again, if you have a private equity firm, you have investors who buy in and they basically lock their money up for 5 to 7 years. It depends on the terms, but like you're basically locking up your money. Now, the good news about that is that markets are volatile. And so it's actually a good thing that you're basically like not able to sell out. And by the way, the best advice that I can get, by the way, this is not investing advice, but like the best advice I can give is like, do not touch your 401k. That's a long-term investment. This too shall pass at some point. But also people have a very unfortunate habit of selling at the lows and buying at the highs. That's how human nature
Warren Buffett says the best thing that can happen during any given point in time is for the stock market to go down.
You're much better off buying when it's down than buying when it's up. But also like hedge funds, by the way, if you are someone who is like managing a long only hedge fund or an equity long short hedge fund, again, your investors can see your performance. Whereas the private equity firms are going to need to get an appraisal because they bought companies. They own companies. They own the equity in private companies.
You say go out and get an appraisal, right? This isn't like order an appraisal on a house and somebody shows up and like does a drive-by or whatever. This is a really expensive to get a private business appraisal or to get opinions from investment banks and things like that about what your investment is worth is an expensive, time-consuming process that involves tons of diligence. The mark-to-market of these investments until there's an exit doesn't change very often.
Yeah. So the point here is if you are a private equity investor, you're not going to be getting that like day-to-day update. And by the way, you can also withstand the storm. You're like, I don't know what Trump's going to be doing. Long-term, it'll be fine. But here's the problem. So if you are a private equity investor, there's a couple of things. Number one, there is the underlying issue of if these tariffs do stay in place, that is actually a problem for your portfolio companies, even if you can't see what's happening day to day. There is a lot of uncertainty. So again, it buys you time for people to not do dumb shit. But the other issue is that these private equity firms, they have investors, they have limited partners, these pension funds, endowments, these institutions with crap tons of capital who needed to basically invest that money. So let's say you're a pension fund. You need to manage paying out pensions for firefighters, teachers, whatever. You have all this money, you've got to grow it over time, and you allocate that money into different investments, just like you would from a personal investing standpoint. You buy some stocks, you buy some bonds, you buy some real estate, you buy private equity. Now, part of the problem is that these funds, by the way, like they didn't start yesterday. It's not like you just bought the company and, oh, yay, like now we can wait for 7 years. These have been investments that were made 2 years ago, 3 years ago, 5 years ago, 7 years ago. And again, ultimately these private equity firms need to exit their investments, and they do need to ultimately at some point return cash to their investors. And the way that private equity firms exit those investments is it could be a sale, or it could be an initial public offering where they basically take the equity and they go to the markets and they take it public. So leading up into 2025, people were, as you put it, like we were at iConnections, people were so excited. The excitement was palpable. We're going to be like record M&A, record IPOs, like everything's going to be great. Tons of money is going to get exited. It's going to get reinvested into our new funds. Like everybody's happy. Well, we had seen a little bit of M&A activity. We had seen some IPO activity, maybe less M&A activity in the first quarter than I think people were initially hoping for. Then the tariffs hit and equity markets in free fall. By the way, the debt markets are also shaky. We're going to get into that too. And all of a sudden, like this magical exit period is not so great. And on top of that, because again, a lot of these institutional investors had invested in private equity a while ago, they were waiting to get money out. Like as they think about their investments, they're already over allocated. Like I think they're over a lot of their risk limits for what they want to be in private equity to begin with. And with what happened with the stock market crashing, what happens is, again, as they think about their investment allocation, with public equities going down, like the total pie almost like shrinks. You think about like how much money you have less money. But on top of that, because the private equity piece has not gotten revalued, now all of a sudden it looks like you have a much larger exposure to private equity and you don't necessarily want that. So there's been a lot of chatter about these limited partners calling up, trying to figure out how can I sell out my stake? Which, by the way, if you do that, you are going to have to take a hit. And I was seeing that like some of the private equity firms are starting to put even more restrictive limits on that and like making people pay more money for that. So that's not good. Now, the other thing, so not only do we have to worry about the portfolio company performance, there's also then the issue that these are typically in private equity, very heavily debt-laden companies with a ton of debt on them. And if you think about what makes up the component of like how much interest you are paying, like if you're going to go out and do a leverage buyout, one of the things that the bank helps you do is figure out, great, who wants to buy your debt? Some debt could be public bonds, because by the way, you can have a private equity firm do a leverage buyout and it's financed with bonds, which are traded in the public market, even though the equity is not, or loans. And so the way that that is priced, it's usually off some base rate. That base rate could be SOFR, which is the base rate for loans. So if you're getting a loan from the bank, if it is for bonds, it is off of US Treasuries. Now, we already talked about what's happening in the
part one is
market.
All that's going up right now. Every single one of those rates is going up,
those are all going
which
up,
makes it more expensive for you to borrow.
Which is more expensive. But then there is the second element, which is like, what is the risk of default for your particular company? Okay, well, we just were told that now there's these tariffs getting slapped on, means lower margins, means lower growth. This means this company looks riskier. Oh, and by the way, they already have a lot of debt. Oh, by the way, they also have these interest payments that have to be made. And so there's often these what's called covenants that are in place when the private equity firm goes out, they do an LBO. There's indentures, if it's a bond indenture, and then loan docs, credit agreements, where the lender wants to make sure that they're going to get their money back. So there's tests and restrictions. So there's things called covenants. You can have maintenance covenants and incurrence covenants. The incurrence covenants just say you can't go out and like actively spend a lot of money on cutbacks on this one thing. You can't go out and actively raise new debt. So it puts restrictions on like what you can actively do. The maintenance covenants say you have to maintain certain credit ratios, one of which is something called the leverage ratio. And so the leverage ratio is just like, what is your debt to EBITDA? That's one of the most common. Another one is called the coverage ratio. What is your EBITDA over interest? Like how many years worth of interest can you cover? And so as our earnings, EBITDA is a proxy for the earnings or the operating cash of the business. As those go down, all of a sudden, those ratios start to look really bad, even if you haven't done anything, like you haven't gone out and raised more debt. Oh, and I should have also added that like if you are borrowing and your private equity firm looking to do more acquisitions and stuff, not only is that base rate going up, then there's also that credit spread, which is also going up, which is again, is compensating the lender for the potential risk of default, which is now obviously higher as well. And by the way, so going back to this existing portfolio company, when covenants get tripped, your bank is then going to be like, And at some point you might need to renegotiate that debt. Like you might actually end up with an event of default, especially if you're not earning enough money. And then you're going to need to renegotiate. And by the way, you're probably going to renegotiate at a high rate. So basically just like moral of the story is like all around, this is like not good, period. Even if you're investing.
One additional wrinkle that I want to layer onto this is how are these deals being financed? Are they being financed through the traditional vehicles of investment banks and, like you said, debt that may or may not be traded in public markets? or are they getting financed via the private credit market, which has exploded higher? And so one of the questions that we asked that podcast guest that we've been talking about a lot internally, the jury's still out, we may never know, but we talked about all these private equity portfolios where these portfolio companies are not getting marked to market. Guess what else is not getting marked to market? Private credit. Private credit looks like it's trading at par all the time, unless you are marking it to market. Because one of the big concerns that I have that I think nobody's talking about. So everyone asks, like, what is nobody talking about?
There was an article today, but yes.
Oh, was there? I haven't read it. But okay, what some people are clearly starting to think that I have been wondering for a while is like, what's the next big shoe to drop? And we had talked about this with private credit in some of our 101 episodes about like the lack of visibility, and everyone we spoke to who is a private credit investor. So like, keep in mind, right? Like they are deeply invested in this product, right? They were like, no, we're even stricter than the banks. Like we're blah, 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 blah. Like we have all these really strict covenants. That's great. But because there's no outside scrutiny of these things, we don't really know. So if all of these private credit markets are being renegotiated between just two parties, which is the huge benefit of private credit, right? Like you can renegotiate your leverage ratios because you're just going to one person versus bondholders. You know, it's in some little old lady's retirement account in Iowa, and it's in a hedge fund account in New York, and it's all over the place, right? You'd have to renegotiate with too many bondholders when there's only one entity that has lent you this money through a direct lending operation. You're just renegotiating with them, right? Great benefit to these companies. But can that potentially conceal stresses within the system that would otherwise get flushed out? Like you said, Kristen, right? Like let's let the most successful loans, right? Not default. There's no transparency to that market. We have no idea what is happening at these individual levels. It
was a Reuters article this morning just about how private credit secondary sales are on the rise as again.
Shocking.
Yeah. So it's the same thing as with the private equities situation where it's like you have these investors who are like,
that's the LPs selling out of their stakes, right? That's not
LPs
default.
selling out of their stakes, not
that's
defaults.
not.
Yeah.
So, and again, LPs selling out of their stakes does set a price on those bonds to some extent. You know, on the value of that investment, but it's not a wholesale revaluation of the market, right? Okay, well, all of these borrowers. So that's one of my concerns about a stress in the system that's not being fully aired out. And that could potentially pose problems down the road.
I agree. All right, guys, we got into a lot today.
Oh my God, this was such a doom and gloom episode. I'm so sorry. I hope you guys learned a little bit about Treasury auctions.
Well, I actually did. I will say I learned so much actually from that. So thank you, because I've seen your Treasury auction stuff before, but like it definitely, this is what I always say, you learn everything so much better in the time of a crisis because like it actually directly impacts your life a little bit. So you're like, oh, now I care. Whereas before I'm like, do I really care about a Treasury auction? Like Jen has a cute little video, but like
it's like how everyone became an amateur epidemiologist during COVID, now everyone's an amateur like economist during the tariff. And again, I want to be very, very clear, guys. There's no script. I've done no prep for this episode. We're literally just sharing the knowledge that we know. It is funny. I did get a message from someone on Instagram who was like, oh my God, I'm not learning this in my finance class. Where can I go read about this Treasury auction stuff? And I was like, this is stuff you can only learn sitting on the desk. Like,
well, that's why I wanted to add that point, because it was actually like, again, back to like Instagram comments. Jen sent me this one comment. Someone was like, basically because you were talking with the Fed and they were like, stay in your lane. And I was like seething. I was like, of all the things.
It was a dermatologist who said that.
You were like, of all the things that you could say stay in your lane for, and there are things that you definitely could, this is where I am an expert. Like,
this is my one lane. If I can't be in this lane, I can't be on the road.
Anyway.
Because they were like, no, the Fed is going to cut rates and it's going to solve everything. And I was like, what?
No, yeah. So anyway, again, I am learning so much. So as much as like this sucks to be in the middle of just whatever craziness is going on, it's definitely not boring. So it also, I think, like is causing some tummy troubles for Jen.
Jen's not doing well. Jen can't eat. Jen can't sleep. Again, Steve Eisman was like, you seem hysterical. I was like,
well, speaking of which, I think what we're going to do, because this is probably going to be like over an hour episode. So we're going to air this as almost like a primer on just what's going on in the bond market, what's going on in
maybe do part 1, part 2. Jen and Kristen on tariffs, and then the guy who was the star of The Big Short on tariffs.
Well, thank you guys so much. And if you have been enjoying our show, send it to a friend if you think that they would benefit from hearing and learning about Treasury auctions and why the bond market is such a big deal. And we'll see you next time.
Bye.
Bye.